What's up guys, it's James Allen, the Out-of-State Investor, and in case you haven't noticed, we're in the middle of an inflation crisis right now. Prices are rising up all over the place at astronomical rates. So today I thought it'd be a good idea to go over what is going on with inflation right now, how this can sometimes negatively affect things like the housing market, and most importantly, what you can do to both take advantage and mitigate and combat against the effects of inflation. But before I get started, do me a favor and support the channel by smashing that like button, and if you haven't already done so, definitely subscribe and hit that notification bell to watch more videos like this. And with that said, let's jump into it. The Bureau of Labor Statistics recently announced that as of October this year, the Consumer Price Index, also known as the CPI, has gone up 0.9% month over month and shows that inflation is currently sitting at 6.2% year over year growth. Now, this is a really big deal because typically inflation hovers around 2 to 3%, so at 6.2%, this is actually a 31-year high. Now, a couple of things that stood out to me on this list. Beef is currently up over 20% year over year. Chicken is up almost 9%. Eggs are up over 11%. The gas you use with your utilities is up over 28%. Used cars are up over 26%. And gasoline is up almost 50% just year over year. Now, what exactly is causing this problem? Well, it's a pretty complicated puzzle, but ultimately what it comes down to is supply and demand. You see, what we're seeing right now is demand is starting to go up from where it was back when we were in the pandemic, and at the same time supply is shrinking right now because of things like labor shortages and supply chain disruptions. Now, one of the tools the Fed has at its disposal is to raise interest rates. See, raising interest rates actually is a way to combat inflation. I'll show you in reverse what it looks like. If you were to lower interest rates, it makes it easier for people to borrow money, which therefore they have more money to throw into consumer goods, which causes more demand and more inflation. Now, the opposite of that also holds true in that when you raise interest rates, it makes money less accessible to the everyday person, and therefore they don't have access to money that they can help to grow the economy anymore. So it slows things down and kind of tapers down the inflation. Now, speaking of interest rates, mortgage interest rates have been at all-time record lows, and there's a reason for this. You see, the Fed has been dumping billions, tens of billions of dollars every single month into buying U.S. Treasury bonds, which helps lower interest rates for mortgages. Now, with that said, the Fed already announced that they plan to start tapering their Treasury bond purchases as of next month. And this is a big deal because this is going to start what people have been anticipating for a while of interest rates, mortgage interest rates starting to go up again. Now, when you dump on that the fact that inflation rates are already going beyond their original expectations, that causes a problem for alarm because they may be tempted to accelerate their tapering of these Treasury bond purchases, which then in turn ends up expediting the process of these interest rates going up, up, up. And this is a big deal for the housing market because when interest rates go up, it makes houses less affordable, which then has a cooling-like effect on the housing market. Now, unfortunately, it doesn't seem like inflation is going to get better anytime soon. Current consumer sentiment is at a 10-year low regarding inflation. Now, the reason why you should care about this is because inflation is essentially a tax on everybody, okay? Everything goes up, and the people it hurts the most is the poor and the middle class, because you see the wealthy have their investments in assets that can generally outpace inflation, and so for those people, they're going to come out on top in the end, but it's the poor and the middle class that end up suffering the most. Now, what exactly can you do about this if this crisis continues to get worse and worse? Well, the first thing I recommend doing is work on increasing your income. One thing you can do is get a side hustle. I actually made a video about 3 side hustles that have 6-figure potential. Definitely check that video out, link above and below in the description. Also, start looking for better pay. I mean, we've had wage increases, there's labor shortages right now. People want to hire people, and people are hopping jobs like crazy because there are better opportunities available. So start looking online for better paying opportunities. Now is the time to take advantage of that. Number 2, invest in assets. Assets are hands down one of the best ways to hedge against inflation, whether it's investing in real estate, investing in the stock market, cryptocurrency, gold. It doesn't matter. The point is, get your spare money into assets right now, because that is going to be hands down one of the best hedges against against inflation. Number 3, avoid taking on variable interest rates. Now with this, I'm talking about things like HELOCs, I'm talking about things like adjustable rate mortgages, anything that may have a variable interest rate, because variable interest rates move with the market. And we already know at this point that the Fed plans to taper their purchases of treasury bonds, which will then in turn end up having higher interest rates, which that's going to affect anybody with a variable interest rate. So now is the perfect time to get that fixed 30-year interest rate. Whatever it is, fix that interest rate. Don't go for variable interest rates right now, and that way you're going to be safe for the long run. Number 4, buy instead of rent. Renting is getting more and more expensive as the months go on because inflation is taking its course with that as well. And there's such a low supply on many of the rental markets throughout the US. So one thing you can do to mitigate against that is getting that 30-year fixed rate buying a house, because that way your monthly mortgage payment isn't going to change at all. And not only that, but like I said, it is still a great hedge against inflation, and with mortgage rates sitting below 3% and inflation sitting over 6%, it's basically like you're getting paid to get that mortgage. Now, if you're somebody that's not in a strong financial position to even think about buying a house or any of the other things I talked about, I highly recommend getting yourself in a stronger financial position. You see, with these consumer goods likely to continue going up with this rapid inflation we've been seeing, it's time to start thinking defensively. You see, if you're living paycheck to paycheck, or even worse, you're losing money on a monthly basis, these are some things you can do to defend yourself against inflation. First thing you got to do is create a budget. Understand where every dollar is going in, where every dollar is going out, so that way you can start tracking everything that's going on financially. Next, you want to consider paying down your debt. Now, especially the high interest debt like credit card debt, that is the absolute worst. You got to eliminate that ASAP. Especially if you're living paycheck to paycheck or even worse, you really need that extra room in your budget to account for the future prices of these consumer goods. So by eliminating that monthly contribution to your debt payments, now you have extra room to contribute to down the road when inflation kicks in. And finally, stock up on non-perishable items. Think of things like toilet paper, paper towels, canned goods. These things can last a long time, and if you buy it now, you're buying it at a discount from when you would be buying it in the future. So overall, I hope you guys found these tips helpful. I hope this gives you a better understanding of exactly what we are dealing with right now with inflation. It's kind of a crazy situation. So hopefully you guys gained some value today, and if you did, do me a favor and smash that like button. And if you haven't already done so, definitely subscribe and hit that notification bell to watch more content like this. Also, let me know in the comments below what your thoughts were, and if you have any questions, and I'll do my best to answer. Finally, follow me on Instagram and TikTok at The Out of State Investor. Thanks again for watching, and I'll see you on the next one.